All right, so let's finish up with the first learning objective for the chapter, and then we're going to get into the second learning objective. Okay, so we've talked a little bit about internal control, and so we just need to understand a few things. Having an effective system of internal control is absolutely essential for any business, but we do have to kind of make up our mind about how much we want to spend on this. What we don't want to do in business ever, regardless of whether it's dealing with internal control or anything else, is we don't ever want to spend $2 to save $1. There is a human element to internal control, and that's when we talk about the human element, we can say that there's this thing called collusion, where two or more people get together. So in other words, we might have a fine system of internal control, but generally speaking, when two or more people are working together to beat it, they can. And then finally, size of the business is important, because some of the concepts we've talked about, such as segregation of duties, for example, we may have a limited ability to have effective segregation of duties if we have a really, really small business with only one or two people working there. All right, so we've got some examples here to finish up. Learning objective 1, it says identify which control activity is violated in each of the following situations. And it looks like our choices are documentation procedures, human resource controls, and segregation of duties. Number 1, the person with primary responsibility for reconciling the bank account and making all bank deposits is also the company's accountant. Okay, well, reconciling the bank account, making deposits, these are related activities, and so we have a violation of segregation of duties. Number 2, Wellston's company treasurer received an award for distinguished service because he had not taken a vacation in 30 years. Well, we need to understand that the reason why he hasn't taken a vacation is probably because he's stealing. Now, there are exceptions to that, but a human resource control might say, hey, you don't have to actually leave town and go to Disney World, but so many days out of the year, you cannot be here. You have to take so much vacation per year. Finally, number 3, in order to save money on order slips and to reduce time spent keeping track of order slips, a local bar or restaurant does not buy pre-numbered order slips. Well, this is a mistake, and this is a lack of documentation procedures. Okay, so we've talked about internal control generally. Now we're going to talk about internal control over the receipt of cash. So this is whenever we have cash that is coming into the business, and all of the exact same principles apply. As money comes in, when we have a register and we have money coming into this register should be the responsibility of one person. When we have money coming in, let's say, for example, through the mail, we have this thing called a remittance advice. If you've ever paid a bill through the mail, and this is becoming less and less frequent, but if you've ever paid a bill through the mail, you generally have to tear a part of the invoice off and send it in with your payment to identify who the payment is for. That's called a remittance advice, and it is a part of documentation procedures. And then finally, down here in the corner, we have segregation of duties. And so when we're talking about getting the cash, when the cash is coming into us, and when we talk about cash, again, I want to make sure we understand, we could be talking about checks. One person receives, well, I guess we've got one person here is receiving the cash, but another individual in the company actually holds the cash before it is deposited. We don't use the same person for related activities. All right? Going with this concept of receiving cash, individuals who handle cash should be bonded. Again, employees should take vacation, and then background checks need to be performed for anyone who is dealing with the receipt of cash. Independent internal verification, we talked about this already, but someone other than the clerk or cashier should count these receipts of cash that we've received, and then a treasurer should compare these receipts to the amount that is deposited into the bank. And then finally, we've got some physical controls such as safes and cash registers that restrict access to the cash before it makes it to the bank. All right. This slide here I think can be particularly helpful for you. Some of the language on it, I've heard cashiers and clerks basically referred to as being the same person before. But if we look at this, we've got a clerk who is receiving cash, ringing up sales. But this clerk is going to send that cash to the cashier to be counted and prepares a deposit slip. Over here we have a supervisor who's getting the register tape out. That register tape is going to have a record of all of the day's transactions. That register tape is sent to the accounting department, who makes actual accounting entries into the accounting information system. And so we have a separation here. We're starting over here with cash, and it's moving from one person to the next, and eventually it's going to end up in the bank. But the people who are keeping track of all of this over here, they may not ever touch the cash, and that's a good thing. So we have segregation of duties for related activities. There are some special rules for receiving payment by mail. Again, this is less common now than what it used to be, but ideally mail is opened by two people, or at least two people are present. Checks should be endorsed for deposit only, and in fact they should be deposited into an account which is set up only for deposits. Let's see here, what else do we have? Each mail clerk signs the list to establish responsibility for the data. Now, if they collude together, they can get past this and we can have a problem, but I just want you to understand this is a control method here. All right? And then finally, we want to have a copy of that list along with a copy of, we can either to go with the checks, or we can even make a copy of the checks to go to the cashier's department, and one for the accounting department. And this is valuable for internal control, but it also helps with customer service if we just make a mistake and lose track of a payment. Okay, so we have a review question. It says, permitting only designated personnel such as cashiers to handle cash receipts is an application of the principle of, what do you think? A, B, C, or D? Well, A and B are the two that you might get confused, but this is an example of B, establishment of responsibility. Okay, establishment of responsibility. That cashier has responsibility for those cash receipts until the shift is over and the money goes to the cashier after that point. Okay, so just as we have cash receipt controls, we also have cash disbursement controls, because we don't just have to protect the cash that's coming in, we have to make sure that the cash that's going out is supposed to be going out. So it says internal control is generally more effective when a company pays by a check or an EFT. electronic funds transfer. And this is absolutely true for most purchases, except for very, very small ones. EFT transactions are becoming more and more common. When you pay your car payment or whatever bills you have, credit card, whatever the case may be, and you pay that online, you are conducting an electronic funds transfer. All right. Other cash disbursement controls are the exact same thing that we've already talked about. We want to use pre-numbered checks. If we don't, we are going to lose track of what we have paid and for what we have paid, what we've used the checks for. If we look at establishment of responsibility, only designated personnel are authorized to sign checks. For example, the Treasury Department. And segregation of duties. One person maybe approves a payment to be made to a vendor, but that is not going to be the same person who signs the check that ultimately will go to the vendor. At some point, we need to have some internal verification by someone not involved in the prior processes. Make sure that our invoices match the checks that are cashed and show up on our monthly bank statement. We've got the exact same thing here for human resource controls, whether it's disbursement or receipt of cash, either way. And then our physical controls, we may not be storing cash here, but because most businesses don't keep a lot of cash on site, but we might have blank checks that we don't want to just lay around. That's a good way for them to turn up missing. All right, review question. It says the use of pre-numbered checks in dispersing cash is an example of the principle of. Anytime you see pre-numbered checks, you need to associate that with a documentation procedure. And a voucher system, when you see the term voucher or voucher system in accounting, we're essentially referring to accounts payable. So it says a network of approvals by authorized individuals acting independently, very, very important, to ensure that all disbursements by check are proper. Make sure that this bill that we received in the mail is actually for something that we ordered, that we received. We actually issue a voucher that says, okay, we have checked this invoice versus what's called a receiving report, and everything is in order, and we're going to send the invoice along with this voucher on to the Treasury Department. So the accounts payable department does not actually write the check, but they issue a voucher so that a check can be cut. Again, segregation of duties. All right, I'm going to let you, well, let's see, we'll go over this, that's fine. It says, Mr. Cortez is concerned about control over cash receipts in his fast food restaurant, the Big Cheese. The restaurant has two cash registers, and at no time do more than 2 employees take customer orders and enter sales. Work shifts range from 4 to 8 hours, and Cortez asks for your help in installing a good system of internal control. So let's look at what he needs to do. Each one of these cashiers should have their own register. That's establishment of responsibility. Each employee should have access only to the assigned register drawer to enter sales. That's more establishment of responsibility. Each customer should be given a receipt. This is so the employees cannot figure out, for example, if they order a number 3 combo and they know that always comes to $7.50, they can charge the customer the appropriate amount, send the order to the kitchen, the customer gets their food, they pay for their food, and the employee has $15 that they never ran through the register. So we need a receipt to the customer so that employees cannot what's called palm the transaction and steal money that way. The employee should do a cash count at the end of the shift, but a separate employee should compare that cash count with the register tape. So this is segregation of duties. The point of sale system should also be automated so that the kitchen does not produce any orders that are not entered into this point of sale system. If we have this right here, we eliminate or we drastically reduce the possibility that employees can palm transactions. Okay, so at this point you have all the information you need to do the second handout for this chapter, and I will also post a video over the solutions for that handout.